We want to present exciting investment opportunities here at the Euro Finance Week, and now it's about global high-yield bonds and loans. Welcome, Dónal Kinsella, Vice President of Eaton Vance. Thank you for your time. What strategy are you talking about today?
So today we've been talking about multi-asset credit to the attendees of the conference today. And at Eaton Vance, multi-asset credit is a strategy that invests across global high-yield corporate bonds, floating rate loans, and it also invests in other parts of the credit market like emerging markets and different securitized credit opportunities as well.
What are you trying to achieve with this strategy?
So it's quite simple. There's four key things that we're trying to achieve with the strategy. The first one is that we're trying to capture what we call credit risk premium. So we're looking for parts of global credit markets where we can get well rewarded for doing good quality fundamental research. And that reward will typically come in the form of higher levels of income. As a result of being focused on parts of the market where credit risk is going to drive returns, we're trying to offer diversification on uncorrelated return streams compared to traditional parts of fixed income that our clients have been invested in, like global aggregate mandates or global investment grade corporate bond mandates. The third thing we're trying to offer is an attractive stream of risk-adjusted returns, and that's characterized by looking to achieve returns in excess of whatever benchmark we're measured against, but by taking lower risk than that benchmark. So we should deliver attractive Sharpe ratios and information ratios for our clients. And finally, we're looking to offer what we call a flexible single manager solution. So a lot of our clients like to do asset allocation themselves, and we're not trying to take away that responsibility. What we're trying to say is that once you decide you'd like to invest in credit markets, come to someone like Eaton Vance who can make nimble asset allocation decisions between different parts of credit markets and perhaps offer exposure to parts of the credit markets that you might not have exposure to in your own portfolios.
What is your philosophy for investing in these markets?
Yeah, the philosophy, again, like with what we're trying to achieve, the philosophy is quite simple. First and foremost, we think that fundamentals and valuations are going to be the best driver of long-term returns from the investments we make. And what that means is that the starting yield or credit spread should be the best indicator of the future experience from an investment in these parts of the market. Secondly, we think you can generate excess returns from a combination of both top-down asset allocation and bottom-up security selection. And Eaton Vance has a long track record of successful security selection across a number of the different markets that we invest in our multi-asset credit strategy. And then the final tenet of our philosophy is that we believe the true risk of investing in these markets is the permanent impairment of capital. And what that means is that you can only really lose money in these markets if you pick companies that default and you suffer losses on those defaults.
But, Dónal, taking more credit risk as the cycle comes to an end sounds risky. How do you mitigate this?
Yeah, so it's a question that we get all the time from our clients at the moment, and what I like to say to them is that just because the credit cycle is long at the moment, and it certainly is long given that it's been running since 2008, it doesn't mean that the end is imminent. So we try and cut through the noise and the headlines and see what the data are telling us. And when we look at the fundamental health of some of the markets that we invest in, we're not seeing those telltale signs of late credit cycle behavior like increasing leverage, increasing M&A transactions, re-leveraging transactions from our borrowers. So that's the first thing I would say, is that the cycle doesn't look to be about to bust from our perspective. The second way that we mitigate against late cycle behavior or the end of a credit cycle is good quality fundamental research. So there will be companies that default into 2020 and 2021, but it's our job as active managers to make sure we try and pick companies that don't default.
Where do you see currently the best opportunities for investing?
So we continue to find great opportunities within the core asset classes of our multi-asset credit strategy, which are global high-yield corporate bonds and floating rate loans. So we're on a company-by-company basis, we're finding attractive opportunities. Within those core asset classes, we are currently moving to an overweight position to floating rate loans, where we're seeing a little bit more of an attractive valuation opportunity there. And then away from our core investments in the strategy, we have reasonable investments in securitized credit, stretching into collateralized loan obligations and different parts of the mortgage-backed securities market. And we've also got some investments in emerging market sovereign bonds.
So we have learned a lot of things. Thank you, Dónal Kinsella, Vice President of Eaton Vance. Thank you so much for your time.